thanks so much for joining us today. We have a really esteemed group of panelists here to talk about venture capital insights for this year. Over on my left, we have Kevin Farrelly from Franklin Templeton, Jingjing Bai, Jingjing, who's a senior advisor at bfinance, and then we have Borus of Ibex Investors, and we have Husseiny from Ventura Capital. We have a very diverse group today. Some of us are from Hong Kong, some of us from London, some of us all the way from the US, and they invest, across the stage. Some are early stage, late stage, growth stage. So I think we're going to have a really exciting discussion today. So thank you for joining us. The venture ecosystem seems to be recovering from the slow period of 2022, 2023, according to Carter data. VC investments increased 12% in the second quarter of this year compared to the first quarter, and the rate of down rounds in the second quarter are also falling across stages to 17.4% from 24.2% in the first quarter. But while valuations generally are on the rise, early stage valuations have not budged. So that's the data. But on the ground, you guys would know much better, what exactly is happening. So maybe if you could share, what is your view? Has the VC world bounced back in terms of valuations, deals, exit opportunities? Maybe Kevin, we can start from your end.
Sure. So I'm very much focused on seed stage, Series A. Valuations have absolutely gotten more aggressive, specifically in my world because I'm focused on blockchain architecture. So all things blockchain architecture are impacted by things like the price of Bitcoin. And so when the things like the price of Bitcoin approach $100,000 US, we start to see founders creep up from their 10 to 13 pre-money style valuation to 20. And then when VCs decide that they're not going to do any more due diligence, you end up with a $50 million pre-money seed round. And so we're trending that way right now, which implies that our take rate is declining.
Okay. Jingjing, what about you? What's your view, your outlook of the situation?
Sure. Yeah, I have been a senior advisor with bfinance for 6 years, so I'm a generalist in private market. But for the purpose of this panel, I'll be focusing more on early stage VC, which I'm building a early stage VC fund, primarily focusing in the US. And I do see early stage VC has been going strong. Although it is a slow market for VC fundraising in general because the LPs just don't have liquidity. They need DPI, need the IPO market to open. So they actually give us the opportunity to access some managers who used to be very hard to access. So I'm very optimistic in the early stage.
Okay, great. Justin.
Good morning. We focus at Ibex with Israel and mobility out of the US. Obviously, with Israel and the war there, it's a tough environment both for fundraising and for companies to get funded. I would say more generally, what we see across both the US and Israel is we're seeing much fewer companies being founded, but the quality of the startups is much higher. Because in this fundraising environment, you have to be a little nuts to start a company. So you're really confident in whatever product technology you're starting, which I think is really healthy. To leave your job and to start a company right now, you have to have extreme confidence. And it's also a bit easier for these teams to hire, where 3 or 4 years ago, you had to pay outrageous salaries to programmers and people to build that initial team. So we think while from the outside world, it looks like a very difficult VC environment, I think it's much healthier from the inside, and you'll see a lot more success stories in the next 4 to 6 years as these companies grow.
Great, thank you. Mo.
Absolutely. For context, we're later down the chain. We're at Ventura Capital, a mid to late stage, deal-by-deal generalist, growth investor. And so the bifurcation of the public and private markets are kind of a push-pull at the moment on valuations, obviously all-time highs in the public markets, dragging up, lagging private markets, which are thawing absolutely. And per Jingjing's point, the recycling of capital, where you need larger tickets at the later stage, is certainly a drag on valuations. So things are looking up, and certainly we think 2025 will be further thawing with the equity markets reaching even giddier heights.
Okay, just to expand on that, LPs have been saying distributions the past few years just haven't been up to expectations. Do you think, that's kind of improving? Our LPs going to be happier in the next 12 months, you think?
Well, we've always had lofty expectations, but obviously IPO market, and we are purely IPO-focused investors, by the way. We'll only invest if there's an IPO, at least in early stage planning, 3 years out, 2 to 3 years out. And so we see really a bunch up and a queue of IPOs, we hope, for second half of 2025 into 26, who knows, crystal ball. But it's been a challenging and dry environment. And really, we've been in investment mode and will continue to be for the past 2 years, and we hope the next 9 months at these, I want to say, bargain basement prices.
Okay, great. I think, Jingjing, you mentioned a little bit about DPIs. Do you want to?
Yeah, because I think it's really case by case, depending on the manager and the LPs. So some managers, they're not really in a rush to exit because their LPs are patient. They know next year the IPO market is most likely to open. What's the rush to get half the valuation, just for the sake of 6 months earlier, right? So given everybody thought, Trump was going to be winning, and the reality is he is winning. So people are optimistic. Next year will be, higher valuation. Markets will be much better for VC exit. But if an LP wants earlier DPI, then the manager, for early stage managers, for them to exit is not that hard, because one of our manager investing in DoorDash with a valuation of $10 million US. They exited 300 times. If they held it today, it's a $50 billion company. They made 5,000 times. Right? So if the LPs want to earlier exit, they can exit at pre-IPO stage. They don't have to wait until IPO until today. But they can always keep some shares for 5,000 times return. Why not?
Okay, yeah, it makes sense. Okay, thank you. Okay, let's move on to artificial intelligence. I mean, everyone's talking about it right now. It's all the rage. And I think each of you have exposure some way or other to AI. Could you maybe share, how AI kind of plays into your investment strategies? Maybe Justin, do you want to start?
Yeah, I'm not 100% convinced AI isn't 3D printing or driverless cars. What I would be very nervous if I'm meeting with a VC fund and they're saying, hey, we're looking at a lot of AI investments. Remember, to use a hockey analogy, you want to be investing where the puck is going. You want to be investing in the big themes of 5 to 7 years from now, not what's hot today. So, for us, it's antibiotic resistance, it's driverless cars, it's a lot of themes. I'd be very skeptical of a VC fund that's making early stage investments in a theme that's hot today. We'll see. I'm sure there'll be some big winners in AI, but more fortunes are going to be lost. Just to give you a little bit of context, in the US public markets, $20 trillion of market cap is in this AI, what I call BS hype, which is going to come out and people are going to get hurt. Again, I'd be very cautious on the AI, especially for VC firms.
Right. Kevin.
Yeah, sure. So I guess before my time at Franklin Templeton, I spent many years building a company using a subset of AI, machine learning, which is a subset of AI. And so when people talk about AI, they sometimes don't break it up into the different components that it's ultimately built of. I think a lot of what Justin just said is very authentic. And I would add on that a lot of these companies that are raising are features. They're not companies, which also makes me very concerned for their future. So in my world, the most applicable use of AI is we use a subset of machine learning to help source founders, products, ideas, what's trending across public networks that allow us to use machine learning algorithms to make my venture process more efficient. Now, I didn't productize that and go and sell it and raise capital for that. It's just something I use internally so I don't have to hire 4 more analysts to go source deals. And so when I find founders coming to me and demanding capital for something that's built on top of ChatGPT or something that may be just a feature and not really a company, I grow very, very wary. I will also add on to Justin's point, this is a big girl, big boy game, and you're seeing a very large corporate money come in to companies like World, and companies like ChatGPT, which were nonprofit and are now for-profit, and they're allocating billions of dollars, right? And so the smaller companies are going to have a really hard time competing with that type of capital deployment, because when you have that type of capital deployment, you have elasticity for failure, meaning you can burn a few billion before you figure it out. So at the seed stage, my appetite's very little, and I think what Justin said is spot on.
Okay, great. Jingjing, I see you nodding.
Yeah,
You agree?
certainly. I agree with the great GP friends we have here, because I'm so humbled in front of this exponential, tech, growth. So many millions of companies and many billions being raised. So, but we want to find great partners to work together, and they're very discerning. They're not just investing in a company because they label themselves the AI to jack up the valuation. It has to be solid business model. They have to be able to generate revenues, right? So of course, most of the VCs, their portfolio companies will have some AI components. Even we are using ChatGPT every day, so it's a part of a life. It's not a way to jack up the price again.
Yeah. So how do you distinguish, like an AI company that is really AI, or compared to one that's just slip in a little bit of AI and it's pretending that they are? How do you distinguish?
Yeah, there are AI native companies, and there are normal SaaS companies that are incorporating AI as a tool and building up AI components. So the lucky part is I don't have to distinguish that much. I rely very much on very smart GP friends.
Okay.
They help me out, because we are still, based in Asia, and most companies, they're in the Valley, in San Francisco. So we really want to work with smart, GPs who will go into the company and talk with the founder to see whether they are, have insights and disruptive in this AI arena, because we know LLM takes a lot of capital to burn to be able to build something differentiating.
Great. Okay, thank you. We'll get to regional opportunities in a minute, but Mo, what are your views on AI?
Yeah, so internally we think of it as applied AI versus the ChatGPT bolt-ons that have been discussed today. You really find some hidden gems. We just paid 12 times EBITDA for an AI drones company that is pure data-driven machine learning in the sky. That's partly European/UK US arbitrage in terms of valuations, but no, per Justin's comments, basically we don't invest on hype either, and there's plenty of hype around. Goldman Sachs predicts a 3% return in the S&P over the next 10 years. I'm sure we're all familiar with that recent statistic. So the bulls are being very cautious. The S&P 500, that's a concentration issue in the market. And again, per Justin's comment, that's an NVIDIA situation for the most part. So I'd be wary. The practical action there, I think, sell off the S&P and look for some good, well-priced private market transactions. My advice.
Okay, sure. Great. Okay, just sticking with you for a minute. Let's talk about the regional opportunities. Where I know you invest globally, you deploy globally, but right now, where are you kind of seeing, in terms of regions, where are you seeing the opportunities?
Sure. So we're global investors, mostly sticking to the OECD. We've invested in China before. We've invested in Xiaomi, Alibaba's IPO significantly, and DD, to be fully transparent. Paytm in India, in the Berkshire Hathaway round, etc. Right now, we're really sticking to the US. We were before last week's result, and we certainly are after the result. US, Europe is certainly a mainstay of us. I spoke about the valuation arbitrage for perfectly good companies which are headed to the NASDAQ and NYSE eventually, and we really try to look for that. APAC is, Asia's not one, jurisdiction, right? I mean, we have an office in Tokyo. We had an office in Hong Kong. Two very different dynamics going on in those economies, but still. You can't beat the US, we think, generally, and then over the next 24 months for innovation, valuations, liquidity, and what have you.
Okay. Speaking of Tokyo, I mean, everyone's kind of excited about Japan right now because of the change, from a deflationary environment to inflationary. Do you see opportunities in Japan?
Sure. I mean, we've always been excited about Japan. You have to be excited about Japan because it takes a long time to do anything over
30
there.
years?
Yeah, 15 for us in terms of building relationships. And myself and we founded the company 14 years ago in terms of Ventura. So in Japan, we actually create our own domestic VC. We have a joint venture with Sumitomo Mitsui where we bring over our international US, UK, European technologies and create domestic VC opportunities within Japan. The reason for that is we've tried very hard to look for mid to late stage in Japan, and the culture of building up businesses is slightly different. Now, of course, there are great opportunities in Japan, but they are further and fewer between than other jurisdictions. So we tend to create our own, and we look to Japan for their institutional finance, which is one of our mainstays.
Okay, thank you. Justin, so you focus on the US and Israel. Do you want to share, what exactly do you invest? What are you looking for, and why do you choose these two markets?
Yeah, we use a mantra around the office: everybody else's trash is our treasure. So Israel, for obvious reasons, it's in a conflict for the last couple of years. It's kind of whatever company you want at whatever terms you want. So it's really exciting, and war tends to create a lot of innovation. If you think back to World War II, we came into it on horse and buggy. We left with nuclear weapons, semiconductors, microprocessors, microwaves, penicillin, jet airplanes, all were invented during war. When the mentality is, if we don't innovate right now, we're all going to die, it tends to be a good environment for innovation. And then we also like a theme where a lot of money has been poured at it, like mobility and driverless cars. People lost a fortune, but it doesn't mean it's going away. Waymo, as an example, has 10,000 driverless car rides a day. Nobody's talking about it. It reminds me of the Wright brothers flying their airplane in 1905. The airplane changed everything, and it wasn't until a year later that a local journalist even wrote about it. So sometimes when people give up on the sector, it becomes the best time to invest.
Great, thank you. Jingjing, so you're based in Hong Kong, but you focus mainly in the US.
Right.
Do you want
It
to
just,
share
I spent a lot of time in Japan. I speak Japanese, and it's my second hometown. So I want to look more in Japanese VC because the government really give a big push, deploying something like $6 billion into VC funds. It's a very small VC market in Japan, but I always think, there's so many Nobel Prize winners. It must be great technology to be commercialized. But still, as Mo said, everything takes a long time in Japan, right? So from lab to commercialized products, it's still a long way to go. So also India is very vibrant in the VC market. I think it'll do really well. But given our limited resource, I cannot cover the whole world. Asia as a market is interesting, but we decided to focus in the US for time being, is because the US has the VC ecosystem, its environment has it's very diversified. You have Chinese, Indians, Japanese, even some Japanese space tech company I looked at, they have to move their headquarters into US to get NASA funding. So still, US is a concentration of talents and capital. That's why we decided to focus in the US because really Silicon Valley is the incubation for the world. A company like Zepto, for example, it's one of the biggest up-and-coming e-commerce company in India, just closed a 3.5 billion round. One of my managers in Silicon Valley invested in the company valued at 2.5 million. So they made 1,500 times. And these two Indian young guys dropped out of Stanford and started a company. So there are cases like this. It happened in the US West Coast and becoming a global company. So that's why.
Great, thank you. Kevin, where are you seeing the opportunity?
Sure. So, I mean, it's global. So, I invest in blockchain architecture. And when I do that, I get equity in a C Corp, which is very important for traditional venture. But then I also get a token. And where I hold that token jurisdictionally is very sensitive. So, I've been very pro ex-America, and now all of a sudden we have a big push in the States to add policy around what is a token, how does it accrue value, is it a utility token, is it a governance token, is it a security. I was most bullish on Southeast Asia, but I have to tell you my best performing asset in the fund right now comes out of Lisbon, Portugal. It's a 6-person team that reached $100 million in revenue in less than 300 days. And so, bullish on Lisbon, Portugal. You have a thesis from a geographical perspective. I have a lot of founders in my portfolio that want to come back stateside now because they feel like it's safe. But I keep an open mind because blockchain, it's global rails. So it's not one geography over another.
Okay. Well, since we are in Singapore right now and this is the global Alts Asia, do you want to share maybe what types of companies you're seeing opportunity here in Asia?
Yeah, sure. So for me specifically, like one of the themes we're really focused on is, the world, very large corporations are looking at very large treasury management of Bitcoin. And when they want to hold that Bitcoin, they then want to earn a yield on that Bitcoin. So they want that Bitcoin to be productive, but they don't want to come out of Bitcoin into fiat, creates tax complications. So I'm focused on companies that are helping to facilitate things like remote staking, the ability to earn a yield on your Bitcoin. I don't want to tout any specific company names because that's, I think, against some rules. But the Bitcoin scaling ecosystem is quite robust here. And I think it's a very real use case for the largest cryptocurrency in the world by market cap.
Okay, great, thank you. So just going back to Jingjing for a second, you are our honorary LP on this panel, and I think a lot of GPs in the audience want to know what exactly LPs are looking for when, kind of selecting the managers to work with. So
yeah, we're one of the good guys. Yeah, so it's the same. We focus on people, right? It's in all private market fund selections. You look at fund managers. Are they disciplined? They roll their sleeves and actually add value to portfolio companies. So that's the key. Of course, they are all very smart. So for us, we are focusing on early stage. It's just my clients they are already allocating to asset class in debt, private debt, buyouts. They've already hit their 15% or 20% IRRs. We want something much higher return perspective for them. So that's why we focus on early stage VCs, and people is everything we count on.
Okay, is there something specific about the people you're looking for?
Yeah, as I said, the discipline. They want them to focus on earlier stage, not raising multi-billion-dollar funds, becoming investment banker, lead the D round, the F rounds, the pre-IPOs. That's very important to us. And of course, we have an in-house rule of thumb. They must deliver 6x DPI in past of their track record. So that shows them they are in the circle. They can really help the companies to graduate to next rounds.
Okay, great, thank you. We have 30 seconds left, so we're just going to do a quick fire. can each of you just tell us something that you feel most people don't know that you want our audience to know? Mo, do you understand?
Sure. I think succinctly, this is the best time to invest in private markets since the dot-com crash. At that time, there weren't, real companies around. At this point, there are real revenue-generating, profitable companies available for very reasonable valuations. And I'd say if you're going to move on alts, now's the time.
Great, Justin.
We're focused on the mobility space. We think the electric driverless car is going to be the biggest technological innovation of our lifetimes, including the internet. And the car hasn't really changed in 100 years, and you're going to see more change in the next 5 to 10 years than you've seen in the last 100 years.
Okay. Well, I don't think there's much that I know people don't know, but I actually just heard something this morning from my panelists. We're talking about the news. The Department of Government Efficiency is going to be named the Doge. And I think, Elon Musk is sort of going to run the country and the world, and it's going to be an innovative world ahead of us.
Okay, that's great. Kevin.
I would just say I think the future of the internet is at stake. And what I mean by that is blockchain architecture possesses all of the attributes that would benefit society like early protocols did in the early 2000s, web protocols, email protocols. It also possesses a lot of the incentives that have made centralized corporate structures very, very wealthy over the past several years. And so if blockchain architecture can proliferate throughout society, I think the future of the internet truly ends up in this read, write, own mentality where you have a contributor economy and we are paid for the services that we use. We aren't treated just like serfs, right? And our data does become ours. And so we are at that inflection point now, and that's why I invest in what I invest in, because I want it to benefit society and people, not just centralized companies.
Okay, great. Well, thank you so much to our panelists, and thank you to our audience for being here with us.
Thank you.
Thank you.
Thank you.